What's up guys, welcome to the door number 15 of the finance calendar, where we dive into 24 financial ratios in 24 days. Don't forget to subscribe so you don't miss any of the ratios, and let's go! Yesterday we talked about the debt to equity ratio, so let's continue today with the debt to assets ratio. It is a ratio that compares a company's total debt to the company's total assets. You can calculate it by dividing the total debt by the total assets. Let's take a look at an example. For the total debt, you want to use all the short-term and the long-term debts. Intel has total debt listed on its balance sheet, but if a company doesn't directly show the total debt, you can calculate it by yourself by adding all the short-term and long-term debts. The total assets can also be found on the balance sheet. For Intel, the total debt is $35.61 billion and the total assets are $167.96 billion. This means that the debt to assets ratio is 21.2%. So what does this tell us? If the debt to asset ratio is more than 1, it means that the company has more debt than assets. If the ratio is 1, it means that the company has the same amount of debt and assets. In Intel's case, the ratio is less than 1, 21.2%. It means that for every $1 of assets, they have 21.2 cents of debt. As with the previous ratios, you can use the debt to asset ratio to compare different companies. Companies with a very high debt to assets ratios finance their operations with a lot of debt, which could mean that they are riskier than others. Companies with very low debt can handle crises better, but might be using leverage inefficiently. Because of this, you should compare the debt to assets ratio with the industry average. As always, use all the available information and ratios when making investment decisions. That's it for today's financial ratio. Hit the like button if you found this video helpful and subscribe so you don't miss any of the ratios in the future. Have a great day and I'll see you tomorrow. Bye!